Debt Market Update, December 2023. Current year 2023 proved to be a volatile year for global fixed income markets, particularly in advanced economies. Amidst synchronized tightening by major central banks worldwide, AEs witnessed significant swings in yields as both growth and inflation exceeded expectations. However, a cooling labor market and easing inflation in the United States, coupled with dismal growth in Europe and the US Federal Reserve's pivot in December, resulted in a sharp correction in yields. By the end of the year, 10-year government bond yields in major countries either remained similar to or lower than the levels observed at the end of 2022. Conversely, Indian government securities yields traded with a narrow range. The long-end yields rallied, while short-end yields closed the year higher than the previous year. The announcement of inline market borrowing in the budget, coupled with an unexpected pause by the Reserve Bank of India in April 2023, led to falling yields in the first half. Further, announcement of withdrawal of tax advantage for investors of debt mutual fund schemes and insurance policies from FY24 led to large inflows to these in end March 2023. These flows pushed the yields lower too. However, elevated inflation, primarily driven by food prices, along with the draining of interbank liquidity by the RBI and the possibility of open market operations sales to manage liquidity, resulted in rising yields in the second half at the short end. India's inclusion in global bond indices and a correction in US yields in the last quarter prevented any significant rise in yields at the long end. The 10-year G-Sec yields concluded the year at 7.17%, 16 basis points lower. Corporate bond spreads widened compared to the previous year due to increased supply. During the year, the average interbank liquidity experienced a significant decline, primarily influenced by an increase in currency in circulation and cash reserve ratio, higher government balances, and open market operations sales conducted by the Reserve Bank of India. This reduction in liquidity was partially mitigated by forex purchases carried out by the RBI. Foreign portfolio investors, including those under the voluntary retention route, made debt investments totaling USD 7.4 billion in 2023, a noteworthy shift from the previous year, when there was a net sale of USD 1.6 billion in 2022. A substantial portion of these inflows, approximately 70%, occurred in the second half of CY23, especially following the announcement of the inclusion of government securities in JP Morgan's global bond indices. Credit markets remained largely stable throughout the year. Credit spreads, which had reached their low point in 2022, saw a modest increase in 2023 due to the expansion in corporate bond supply. However, these spreads still remained below historical averages, as demand from banks continued to be robust. Outlook. In current year 2023, the Indian fixed income markets demonstrated relative stability, particularly in contrast to the high volatility witnessed in the debt markets of the US and other advanced economies. This resilience can be attributed to several factors, including a low risk of fiscal slippage, consistent demand from long-term buyers such as insurance and provident funds, easing core inflation, a correction in commodity prices, and a comfortable external sector characterized by ample forex reserves and a manageable current account. The outlook for fixed income for 2024 remains favorable in view of the following key drivers. Inclusion of India's sovereign securities in JP Morgan Bond Index bodes well for demand outlook for G-Sec in next year and can effectively cap any significant rise in yields. Core CPI momentum remains subdued on back of lower input price pressure and benign global commodity prices. Inflation expectations also remain well anchored and are trending lower. Government likely to continue on path of gradual fiscal consolidation, and thus market borrowings are likely to remain within manageable levels. External sector likely to be supported by steady services exports and adequate foreign exchange reserves. Rate hike cycle in AEs has ended and expectations of rate cuts are high during the year. RBI is also likely to cut rates in second half of CY24. However, we expect a shallow rate cut cycle. However, there are counterbalancing factors which can put upward pressure on yields. Regular food price shocks can keep headline CPI elevated and can adversely impact inflation expectations. SLR holdings of the banking system is high and credit growth robust. Further, the demand from insurance sector is likely to taper down vis-a-vis last year. Hence, incremental demand for G-Secs is likely to remain muted. Risk of rise in commodity prices, especially crude oil. On an overall basis, in our view, yields are likely to trade in a range in the near term. Although, we believe that long end is likely to outperform over the medium term. Given the expectations of shallow rate cut cycle, we continue to recommend investments into short to medium duration debt funds. However, given the elevated level of yields at the long end, investors could consider higher allocation to longer duration funds, in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.